What's up, guys? Welcome back. So yes, I called the Greeks the cheat code of options, the options cheat code. And the reason I do so is because you don't necessarily need to understand the Greeks to trade options. I mean, when I first started doing it, I thought that they were just like a random bunch of numbers, like something that like the super geeks thought about and talked about. And then I started hearing regular people talk about it too. And I'm like, wait, is this something that I really need to know about? And it was just described as me as an opportunity and a way to give yourself an advantage, to mitigate risks, to make strategies and things like that. And I found out that they weren't just random numbers. And they're also very, very easy to understand and very easy to apply to different options that you might be trading. Whether you're buying calls and puts or selling them, it does not matter. We can use the Greeks to our advantage. And like I said, to make a couple extra dollars, but even furthermore, to protect us against the dangers and the risks of options. So in this video, we're going to talk delta, we're going to talk gamma, we're going to talk theta, Vega, and even that weird kid down the block that nobody really likes to hang out with, Rho. And like I said, I'll explain them and apply them to each one of the options and show you how I use them in my everyday trading options strategies. So right now, if we're looking at this Tesla call, right, and this Tesla call right now is $800, right here is the Greeks. All right, now if you're on the app, you are going to have to click the bid-ask spread. It's a blue hyperlink if you're using Robinhood or whatever brokerage you're using. This is where the Greeks will pop up. So I'm going to screenshot this and I'll put this into a digital whiteboard and then we could talk about it. Now, each one of these Greeks, guys, they have like their specific definition, but I think more importantly are the implied things and the theoretical things that these are going to give us. That's really where we can use them. The technical definitions, they really don't mean that much, but like I said, not that they don't mean that much, but they don't really help us. It's more the other things that like the unspoken rules that are really, really important. And those are the things I think can really add some value to you in this video. First, let's talk delta. So first, the technical definition. Delta is how much the option's value is going to increase or decrease with a $1 change in the share price. So let's break that down and make that a little bit simpler. Right now, we can see that the current premium for this option is $16.65. And let's say the current share price is $820. What this delta of 0.63 means, and guys, these are going to be in terms like contracts are 100 shares, so this is going to be per share. What that means is if this were to go up, that means the share price increased $1. That means the options premium will be affected by this delta. So that means that the option price will go up 63 cents. And the option will now be worth 17.28. Now this works in reverse as well. If the share price went down to $819, then the premium would go down 63 cents. So for calls, guys, delta is going to be anywhere between 0 and 1. And the further we are in the money away from the share price, the closer to 1 we're going to get. We theoretically can't get to 1. Theoretically, 1 is the delta if you own the share. And we'll talk about that in 1 second. But delta is going to be between 0 and 1. For puts, delta is going to be between 0 and -1. And the reason for that is in calls, when the price goes up $1, that's going to be positively correlated to our value. But with puts, we want the share price to go down, okay? So as the share price goes down, that's going to increase the value of our option. So we see this range anywhere from -1 to 0 to 1. And really, a rule of thumb, guys, at the money, that's usually going to be a 0.5 delta. And we'll see that and the reasons for that in just a second as well. Now, I mentioned the difference between the textbook definitions and like theoretical things that we know. Here are some theoretical things that delta tells us. So here's one thing I tell people all the time and they just do not understand. It's theoretically like owning that amount of shares. And here's really what that means. You can't have a delta of 1 in a call option, but let's just say we did, just to prove a point. If I had a call option with a delta of 1, that means that every single time the share price goes up $1, that means the value of that option goes up $100. But now let's say I have a call option, this call option here, with a delta equal to 0.633. When the share price goes up $1, we make $63. So like I said, it's like owning the shares because it goes up in value the same amount as if we own 63 shares of that particular stock. So when we say things like, oh, we use delta to identify roughly how many shares we're leveraging or how many shares we have, this is the reason why. Because as the share price goes up by $1, delta changes the value by that same exact amount. So my leaps video from last week, guys, I talked about how when I do leaps, I like to look for a zero point 0.7 delta or more. If the share price goes up by $1, the value of my option is going to go up $70. It doesn't go up 100 because I don't technically own the shares, but it is like owning 70 of those shares because the response in value is going to be the same. Now, another rule of thumb that we use, Delta guys, it is roughly equal to the percent chance that this option will become in the money at some point before expiration, okay? So this is where we can use Delta to identify some of the risks that we want to take. And this goes back to when I mentioned again, an at the money option has a 0.5 delta. It has a 50-50 chance of becoming in the money, going out of the money, or staying right at the money. It has a 50-50 chance. As we go down further in the money, right? As we go down this way from the share price, we know that the likelihood of success is going to be greater. And that's why Delta increases the further in the money we go. So maybe you're new to buying options and you kind of want to dabble, you want to try them out. You don't want to take on a ton of risk. You might go further into the money to say a delta of 0.9, even 0.95. That theoretically is going to give you a little bit of an idea that this has a 95% chance of becoming in the money at some point. And I also use this when I'm selling covered calls, right? I can use this delta as well. If I don't want to get a sign, right? A covered call is a bearish strategy. So what I'm going to do is I'm going to pick a very, very small delta, which gives the buyer a very, very small theoretical chance that this is going to expire in the money. So I can sell a covered call with a delta of 0.2. That means that I have an 80% chance that it is going to expire worthless because the buyer only has a 20% chance that it's going to finish in the money. And here's where we kind of can use those rules to help us manage the risks that we are willing to take. So maybe you're like a YOLO kind of guy and you want to save some money in premiums because premiums are less expensive when you're buying options at the money. So you take on the 50-50 chance and you buy an option right at the money. Personally, I don't do it because my risk tolerance is a lot lower. So I use Delta not only as a way to identify how many shares this is like owning, but also the likelihood that I'll end up in the money at some point. And because of this positive and negative delta, guys, this can kind of identify the direction or what we think the market's going to do, right? If we're selling a lot of positive delta, that means we're kind of bullish on the stock market. We think the stock market's going to go up. Or if I have a bunch of negative deltas, that means I think that the share prices in the stock market is going to go down. So we can use this to kind of identify what type of trader, if we're looking from the outside in and looking at people's options. So now I'm talking about how much delta changes as I approach the money. It's not a constant number. And you're like, okay, well, how do we identify that? We identify that change in delta using gamma. So gamma is how much delta changes with a $1 change in the share price. So both gamma and delta, they are affected by the share price either going up $1 or coming down $1. So once again, let's take, for example, this premium that we have up here of $16.65. It currently has a delta of 0.63. So if the share price goes up $1, okay, so we could see that now it's going to be this. It's going to be that 17.28. But now, after that $1 change, the new delta is going to be equal to 0.6333 plus gamma, which is going to be 0.0131. So we could see that now we have 6464. That is going to be the new delta at this price. So essentially what's happening is gamma is accelerating delta. It's making it change, which could be a good thing. It can accelerate the value in our favor, but it could also be a bad thing. It could also accelerate delta against us. And we'll see gamma change also as we approach the money and as we go further away from the money, whether that's out of the money or in the money. So we have to kind of look at how these two are playing together. And this is kind of the reason why you might want to roll an option, all right? Because as we get closer to expiration, the difference between gamma now and when gamma was far out of expiration is very, very different. So we might roll to put some time back on our side and lower gamma just a little bit so that it doesn't accelerate delta and just have our value of our option making these major swings. So when I get at the money, gamma becomes very, very large. But as I move away from it, what we'll see is that delta will really start to shoot towards 1 or -1. But then as I get further in the money, out of the money, what happens to delta is it kind of slows off. So if I kind of just do a rough sketch of that, if I had like a delta of 1 up here, and this is at the money, and then this is like increasing in the money, at the money, Vega's going to make Delta shoot up, but then it's kind of going to like slope off and never, like I said, reach 1. But the further in the money we go, the less Delta is going to change with the $1 change in that share price. So the next one we're going to talk about is Theta, probably the most popular one, like the Theta gang strategies and all that. And all Theta is essentially it's pay to play. So we've talked on this channel before between the difference between intrinsic and extrinsic value, and all Theta is how much your options value is going to decrease every single day because it eats away at the extrinsic value. And this is assuming that we keep the share price and implied volatility pretty constant. And like I said, that's the pay to play. This is how much this option is going to cost you in extrinsic value every single day that you hold it. And guys, Theta really ramps out about a month out. Essentially, if we have an option, that Theta is going to kind of decrease. When you get to 35, 45 days out, it's really going to start to ramp up until we get to expiration here. And we can see this option is at expiration. We'll hop in and look at a couple different expirations and show you the difference. But essentially right now, this is losing $542.73 every single day off of this $1,665 premium. It is just crushing this premium right now. So this is where expiration date and choosing options can really, really help you. Like when we're buying options, right? We want to have a long out expiration because we want to play in this zone from here to here where Theta is not eating away our premiums. If we're selling options, right, and we're looking to buy to close later, we want the value of the option to go down. We've already collected the premium. So if we're looking to buy to close to lock in some profits, we want to buy it for cheaper than we paid for it. So we're going to place our options, like our covered calls and things like that, within 30, 45 days so we can have this Theta really, really help us. So Theta is really, really good for sellers, really, really bad for buyers. Now, students in my course and things like that ask me all the time, like, when does Theta happen? Guys, there's no like theoretical time. It doesn't happen. I said, we're assuming that we keep the price and implied volatility constant, which we know does not happen. Like, it's not the end of the day and it's like, boop, all right, there we go. I'm going to take that $542 off the premium. It kind of just evolves and works itself out with all the other Greeks over time. So it's not like you have to get your option plays done today because when the bell rings tomorrow, all of that Theta is going to be gone. There's no specific time. It's kind of just how it works in over a 24-hour period. Like I said, assuming that the share price and implied volatility stays the same. Now, speaking now of implied volatility, when I see volatility, I think Vega. So Vega, guys, very, very, very important. And remember, Delta and Gamma, they deal with a $1 change. This is going to be a 1% change in the implied volatility, which is why I kept this up here as well. And I've seen implied volatility really, really hurt people, and Vega just crush hopes and dreams because we think when we buy a call, and here's back to that cheat code, we think when we buy a call, if the share price continues to go up, the value of the option should go up, right? Because of intrinsic value. But this is where Vega can really, really hurt you because if implied volatility dives, right? If implied volatility dies, that's how much Vega is going to hurt you. So stocks with high volatilities that can dive out, you can lose money. Even if the share price is going up, you can lose money on that option because applied volatility will just dive. You might have heard something called IV crush before. This really happens around earnings and why it's really, really recommended that we don't buy calls before earnings because before earnings, volatility is super high. And then after the earnings call come out and we get all that information, what happens? Implied volatility just dives and Vega just crushes options premiums. All right, so we need to watch that and understand it, that if you, like say today was a little bit before earnings, right, this value might be here. Let's say this implied volatility was 168. Well, after those earnings calls, this could go down 68%. Now we take this and we say $15 times 68%. That's how much your option premium is going to get crushed after earnings. Please don't buy calls right before earnings, guys. I beg you, and this is it. This is how you can lose money on your option, even if the share price is going up, even if Delta is going up, because implied volatility, I stay away from implied volatilities over 100. It's just too risky for me. Like I said, I look at 68. That's still even a little high. I think right now SPY has like a 14% implied volatility. So Vega's really not going to affect the options premium that much. All right. And we saw last week with some implied volatilities, they go up to 3,000-4,000%. If we get some information and that volatility goes down, your option premium is just going to get crushed and it might not ever recover in the time that you have before expiration. Be careful about Vega. It's like one of the ones that like people don't know about. And I said that IV crush around earnings time, that can just destroy people's premiums, and you're going to lose out, even if the share price continues to climb up until expiration. The last one here, guys, row. I'm not even going to write it down. It doesn't really need to talk about it. Even from the beginning, even if I think if you're a little bit more advanced, you really don't even need to worry about row that much. It's how much the options value is going to change with changes in percentage interest rates through the treasury bonds. Like I said, that doesn't change very often. So this isn't something that's going to affect you on a month-to-month basis. So I don't even worry too much about row. Just know that it has to deal with the interest rates of the treasury bonds and things like that. Let's shoot over to Robinhood and see all these things. It works at different strikes, different expirations, and things like that. All right, so this expiration is literally tomorrow, okay? It's literally tomorrow. So what do we expect? We expect a really, really high theta. It is at the money. We expect a delta 50-50 chance of this happening. Now, as I move further away from the money, I don't expect Vega to change too much. Theta will change a little bit, so will delta and gamma. So let's go a little bit here. We can see right now, 0.53 up to 0.6. We're further in the money. Theta still hurting us because that's mostly going to be time to expiration. Let's move expiration out 1 week and see what it does to theta. So here's that same 805 strike price, $164 every single day. And this is only 1 week out. So we can see how significant that one changes. $164. If we go back to tomorrow at that same 805 strike, we see 500. So $400 per day difference when we do that. So let's see how delta changes as I go farther into the money. If I get down here, we see that we have a delta of 0.97. So the further in the money you go, these are things that you're going to look at. If I want to sell a covered call, say I own some shares, I'm going to sell a call. I'm right at the money. I see once again, 50-50 chance, even when you're selling the call. If I go up to this, 825.26. So now I'm giving myself even more likelihood that this covered call is going to expire worthless. I go all the way up here, almost 0.2. This is about an 80% chance in my favor. Okay, guys? So this is how you are going to use the Greeks to help strategize and eliminate some risks. If you like this presentation, guys, this is how I break down everything that you have to know if you are a beginner options trader inside my options course. I'll leave a link for it down in the description below. I'll give you 50% off if you use the code OPTIONS. I'll leave all that down there. You can see everything from buying calls and puts, selling calls and puts, the wheel strategy, bid-ask prices. I got everything. Click the link. Just look at the description, and then you can make the decision. I'm just letting you know that it's out there. Yes, I know that you could probably find it and spend hours looking for them in the proper order, or you could just take 4 hours and watch it all in one spot. Guys, I hope this helped. If you have any questions, leave them down in the description below. If you want me to teach you something else, you want me to break down another options thing, please let me know. You guys helping me. This is how I make this content, from you guys giving me recommendations and telling me what you want me to explain. Until I see you guys on the next one, stay positive, work really, really hard. Always, I beg you, please be kind to other people. Hope you have yourself an amazing day, an even better tomorrow. And oh yeah, I just hit 50,000 subs. Thank you so much, guys. Everybody, I appreciate all you watching. You really do. You make my freaking day. So thank you, 50,000 subscribers. Couldn't be more pumped about it. I hope when we're watching this video in a year, I got like 10 million. We'll see. Take it easy, guys.